Hey guys, this is Joe Hamill, founder owner of Realty Team, and today I want to talk about probably one of my favorite topics and favorite metrics, and possibly because it's like so often misunderstood or not focused on, and something else is focused on. And so I want to dive into what that metric is, what it's compared to, and then I'm going to compare and then analyze the most recent deal that I've bought, show all the numbers and the perspective behind it, and if you like it. My wife and I, we own 20 plus properties. It's like 26 doors. The cash flow is over $100,000 a year, just in the last couple of years. So it's all Metro Detroit here, and just starting in from zero to here, the amount of perspective that you gain is tremendous. And so that's kind of what I'm trying to share here. And it's just to kick it off. One of the biggest things that we've learned is that it's so many people hyper focus on year one cash on cash ROI and hyper focus on comparing that number to the benchmark of the stock market. So, stock market, I can get 7%. It's done that for 100 years. Fair. So cash on cash, if I want to invest in real estate, I want to get 10% plus. So we get 10%, 12%, whatever. But the very first thing I want to pick apart there is cash on cash ROI. Cash on cash is comparing, what's the analysis of if you buy $100,000 house and you put 30 grand into it, your investment is $30,000 and say cash flows, 3,000, 3,600. Okay, now your ROI is, your cash on cash ROI is 10 to 12%. Well, that is based on only the cash flow. And that would be like comparing to a dividend yield in the stock market. It's not the same thing. So cash on cash ROI is just based off the cash flow, not your equity, not your principal pay down, not your appreciation. And no one looks at the dividend. I mean, they do, but no one really is talking about the dividend yield of a stock. I mean, that would be like 0.0 whatever percent. And most of them don't even pay a dividend. So the only way you should truly compare real estate to the stock market is equity. The equity you build in real estate, or total ROI. And people don't do that. And that's why you can buy real estate at what appears to be a lower cash on cash ROI. And it's still the best investment in the world. And all the rich people are still buying real estate because they're not just looking at cash on cash ROI. They're looking at it as an investment. So, to dive into this, I want to pick up a property, or I want to look at a property that we just closed on, and let's just talk through this. I'm trying to go quickly so these videos aren't long. But say 3030 Alvina, just closed on this, pending in December, closed in January. 120,000. We did get like 2,000, 2,500 bucks in concessions. Just straightforward classic. So for the record, this is the only 3-2 that we own. Everything else is a 3-1 or a 2-1. This is also one of the biggest ones that we own, but that's why, I mean, this one ends up, you'll see it's 5% cash on cash ROI. Like, none of you would probably buy that house. Like that's it's on the market for 19 days. But this was something I was targeting, it was brick 3-2. We have 25 units. So take a slightly lower ROI to get something we wanted. And so here's what it looks like on paper. This is just a long-term buy and hold. Now if you watch any of my other stuff, every deal is a burr pretty much every 3, 4, 5, 2, 10. years, you should be refinancing and pulling out that money, starting over again. That's how you're really going to maximize it. And again, you can't do that this is the same way in the stock market. But that's another conversation. So, but just to look at this one on paper, I analyze this essentially how most of you obviously, um, like I self-manage. I put management in here, but we self-manage. So yes, my numbers will be higher, and anyone who self-manages numbers will be higher, but that's just the advantage you have if you're self-managing. So purchase price 120, purchase closing costs. Usually I'm using like 5,500, maybe 6,000. Again, we got the concessions off, so I put that in the report. This is a bigger rehab, $20,000. ARV 155. So you're looking at a $12,000 spread there, which is nothing fancy, especially if you were to try to flip this, you'd have commissions and costs in there. So not a huge margin, but again, sometimes you just got to pay and put in the sweat equity to get what you want. So again, loan interest rate, 7.25. You get the point. Someone would look at this deal and they would just pretty much pass. Everyone did, sat on the market for a long time. But if you put this in a total ROI calculator, this is what I really want you guys to look at. I'm just gonna flash it right out the gate to hopefully keep your attention spans. 34% total ROI. So if you're actually comparing my investment and how much ROI I've created, or how much money I've created on this deal, it's 34%. That's the number you should be comparing to the stock market. And say you don't want to compare that number to the stock market. Okay, well, just compare the equity of this deal. So I'll break these numbers down, but the cash flow is of 5%. That's 5.6. That's the number that we were looking at, 5.6. So take that number out. Your debt pay down is almost 4%. That's because the tenant is paying down your mortgage each month. So that's technically money going back in your pocket. You just don't see it because it's going into the loan. Tax savings, I'm just going to leave that out for right now. Appreciation, 15%. Well, yeah, but Joe, I thought they only appreciated 3%. Right, but that's a leverage. If I buy a $100,000 house and I put $25,000 down, it's the $100,000 that's growing at 3%. So $100,000, that's $3,000. Well, $3,000 is $3,000 on top of the 25 grand is closer to 15%. So hopefully you caught that's the power of leverage in real estate, is that the total price of the house is appreciating, not just your investment. Versus the stock market, if you put $25,000 in, that grows at 7%. That's a lot less money than $100,000 growing at 3%. That's the big difference there. So you're looking at almost 19% on this house in equity versus the stock market 7%. So someone else would be like, I don't want to buy this. I can get 7% in the stock market. That thing's only 5%. You're wrong. This thing is making 19% just in equity versus stock market. So that's probably the biggest thing. I'm just going to kind of flash this calculator. You can look at it. Every FRT agent has this calculator and can run these, and you can and should be asking them for this if you're coming from this perspective. But all these same numbers are in here. You kind of the calculator is correct. As your cash flow, that loan pay down, appreciation, 34%. That's probably the biggest reason why we're closing on this, and it's the biggest thing that people are getting wrong or missing. Something I quickly realized was we're not making the majority. We're making plenty of money in cash flow, and that's what we like. You should be making money in cash flow, but we're making a lot more money in equity. And so I definitely don't say chase appreciation market, because we see in 2023, technically Metro Detroit was the highest appreciating market in the country. So, and markets like, I think it was Houston or Austin, I make fun of because they went backwards, 8 or 10%. And I make fun of just because they're like boasting their appreciation markets, and they didn't. So Metro Detroit, best cash flowing market in the country. Last year, it was the best appreciating market in the country. Get both, 34% ROI. This is the number you should be looking at. Especially right now, it's tough to find deals. And you have to have a broader perspective. And this is when we closed. You can look at it as 5%, or you could look at it as at 34%. We're looking at it at 34%. Hope that helps. Fire Realty team, Google us, whatever, and reach out if you want to buy a couple of these.